Hello, everybody. Welcome to Pod TV's Wall Street Hackers, where we discuss the economy, the markets, stories of the week, quote of the week, and also Peter's picks. So we get to look at the market in detail, where it is, where it's going. I'm Nick Palavito. I'll be your moderator for today's program, and we're going to bring in the hacker himself to give you the insight into the markets. The hacker himself, of course, is a graduate of UCLA, where he received his bachelor's degree in economics. He also received a law degree at the University of Miami and a master's degree in business administration at New York University in New York, where he spent 17 years working, sweating at the area of the stock market, working on the stock market. So with that, we're going to be bringing the guy who spent 17 years in the sweatshops of Manhattan, the hacker himself, Peter Bennett. Peter, welcome to your show.
Hi, Nick. Hi, audience. No, I really wasn't sweating that much. I mean, there were tense times, but it's always rough on Wall Street at times. Anyway, welcome to the 3/4/24 edition of Wall Street Hackers. You can catch a new episode almost every week. Pretty steady right now, every week on Thursdays or Saturdays, starting at 1 o'clock. So we always start with the markets, and let's look at some quick trends. The core PCE index has been trending up. The core services index has been trending up. The durable goods index has been trending up. Predicted rate cuts, as U.S. forecast, as we forecast on Wall Street Hackers, is trending down. Unemployment claims remain historically low, and there are about 8.8 million unfilled jobs in the United States. Government deficits and spending keep climbing, and there doesn't look like any solutions coming in the near term at all. We're heading into an election year. Doesn't look like there's any interest in cutting. And the biggest thing is Social Security and Medicare unfunded liabilities are probably 4 times what they're admitting are the actual liabilities for the country. So the thing about that is that's all known knowledge by many people or some people. The Medicare thing is kind of underplayed, but here's what concerns me about the markets right now, more heading into this summer. Now, no one can say for sure, but I wouldn't be surprised to see oil prices above $90 a barrel or even higher, maybe even over 100 this summer. Here is some very recent news on oil. U.S. oil production for January 24 came in at 12.5 million barrels, which was well below expectations. OPEC just predicted 2025 use will be up considerably. Russia has decided to reduce its crude production, and it's saying because it wants to comply with OPEC requirements. But it could also be because Ukraine had a lot of success attacking Russian refining assets, and so they destroyed, at least one article said, 15% of Russian refining. So maybe that's why they want to cut back. They don't have the capability to do more now. As for Mexico, Mexico is cutting some exports of oil as global supplies tighten. The Mexican state-run company called Pemex is canceling contracts to supply refiners in the United States, Europe, and Asia. And the company is instead diverting resources to its own domestic refiners. So this is what we said in the fall, that you can't rely on falling energy prices to keep driving down inflation. And there could be a very big misreading as it looked like inflation was getting under control. So here's 2 quick charts. This is the first one. And what you'll see is the down arrow, which shows that basically oil prices were trending down from September, mid-September, maybe a little later than mid-September, to December. You can see that. Now, where that blue is over there with that arrow, right at the very bottom, it couldn't be lower in terms of, oh, by the way, this is the USO, which is the United States Oil Fund. And I would warn you, it's not a long-term investment vehicle. You say, oh, I want to buy oil. But because of its use of derivatives and backwardation, something like that, you can lose money on that, even if oil prices are going up. So it's a very short-term trading vehicle. But the point is, Chairman Powell sent a very dovish message. And maybe it looked great to him because that was the low of oil around December. So the problem now is let's look at oil prices from January. Again, this is the USO from January to yesterday. Slight difference in trend. So we're talking about basically $68 a barrel in December, now 81 at the close yesterday. That's a big jump. And, if you follow the trend lines, traders do that. I'm not a bit as big on technicals, but there's a pattern here, and it's straight up at an angle. And so nobody can say when that angle is going to stop. But what if, and I think it could easily go through 90, 100, hopefully no higher, but even then. So that could be a shock to the market because as it goes up, the Fed's going to cut back on their 2 3/4, let's call it, rate projections, because they almost came down to 2 at the last meeting. And the market is going to be a little surprised, especially the growth stocks, because they'll be affected by inflation a lot because they don't, they build in a lot based on interest rate assumptions. And if they think interest rates are going longer, well, that'll turn that sector potentially. So, of course, at Wall Street Hackers, we like to look at cause and effect. We're not just looking at backward numbers, but inflation looked good coming into December, but now it may not look good at all heading into the summer and the summer driving season. And this, by the way, will be the focus of our panel discussion of the week, which is where is energy policy in the U.S. heading? And it's a lot broader than just short-term energy prices. There's a lot of issues there. So what to do, as always, for years now, we've been saying this, and it's worked out very well. One, own selected energy companies, producers, because they'll do very well with inflation. I believe oil is the best hedge against inflation. Gold, it doesn't correlate as well as you think, but oil is one place to be for inflation for sure. Two, own energy pipelines, because I think they'll do well in almost every environment. They just have a history of tremendous growth, and they're, to me, the only place to get high yields, preferred tax treatment for some people. Safety, I believe it's one of the safest. It's almost like a utility because of demand pull and long-term contracts and growth. So what else do you want but value, growth, and dividends? That's what most investors are categorized by one of those. What I want in my investments is all three when I can do it. So whatever the macroeconomic environment, I think pipelines are going to do very well. Energy should do well. And finally, of course, our favorite chart, I mentioned it almost every week, shows that whatever you have in stocks, whether your allocation is 40%, 60%, 20 or 80, you should have it in dividend stocks. Over 50 years, our favorite chart shows that dividend stocks outperformed the S&P 500 by double until 2022. So 1972 to 2022, doubled the performance. That seems like a better place to be safety-wise and performance-wise. And dividend growers and initiators actually scored a triple over the S&P 500. And as we talked about last week, dividend companies that dropped their dividend or didn't increase or where it declined did terribly, barely got any performance. So that is what to do. Just a couple of quotes and kind of a shift because I could have pulled on oil too. But of course, the other big concern is national debt, which is in the long run totally out of control. So 2 quotes of the week. One from Ken Griffin, who was the founder and CEO of Citadel. This is a smart guy and a very successful hedge fund. Quote, "We must stop borrowing at the expense of future generations. It is irresponsible for the U.S. government to incur a deficit of 6.4% when unemployment is hovering around 3.75%. That's what he wrote, but here's where I disagree. He's talked about future generations. No way. I think this is going to affect the economy and the macro environment in general and investors if they're not planning properly in this decade. And certainly within the next decade, if we can get by in this decade, you can't have these kind of unfunded liabilities without some effects." The other quote was from Jamie Dimon. It was in the same article, and he'd said this earlier in the year. He said he was sounding the alarm on U.S. debt. He said that the debt to GDP ratio has not reached the, quote, hockey stick surge yet. But he said, quote, but when it starts, markets around the world, by the way, because foreigners own $7 trillion of U.S. government debt, there will be a rebellion, and that is the worst possible way to do it. Yes, I'd say it's the worst possible way to do it. Wait until there's a debt crisis and then think about it, when we should have been planning this for decades in terms of Social Security and Medicare, and certainly we should be planning now for the other spending. So I think it's 100% that there's going to be some kind of crisis in the next years, probably almost certainly this decade. And it's very likely, and certainly the government's going to try to use yield curve control to bring rates down to zero, because that's the only way they can afford the interest on that money, because they're going to be printing a lot of money. No way to tax that kind of money. There isn't enough money in the world. So 5 most interesting stories of the week. Interesting story number 1. Last week we discussed how regulations are now in force, which are going to make it very difficult and like almost impossible, very expensive to buy gas-powered cars just by 2030. But this week, the Biden administration, in their efforts to fight climate change, came out with new regulations that are going to apply to short-haul trucks and long-haul trucks. And we're talking about all trucks, basically, delivery vehicles, garbage trucks, school and bus trucks, and even fire engines. So the rules are going to kick off in 2026 for model year 27 and become more and more stringent until 2032, when all trucks and buses basically are going to be zero emissions. Right now, less than 1% of truck sales are zero emissions, probably because of the technology. The trucking industry has warned that these stringent measures could have far-reaching economic repercussions. Shark Tank's Kevin O'Leary agreed with the industry, and he said, quote, I don't know if it's quote, he said, the Biden administration's stringent emissions standards for big rig trucks are based on technology that doesn't exist in a broad enough capacity and could cripple the small business economy. So I understand to a point, and we'll be discussing this, the climate change fears, but just plunging into things that don't make any sense or can't be done is just political. And if this does go through, it's going to have a major impact in terms of the trucks, because when you start adding a lot of expense to delivery, that flows right to the consumer. Interesting story number 2, China's has now 65 million homes, 1/5 of the total, that are lying vacant, and real estate prices have collapsed to 2018 levels. Tens of millions of Chinese have plunked down their life savings for an apartment in a high rise that they will never live in because the builder went bankrupt. Great plan. China's official, and it's quote official because who knows what the truth is, China's official youth unemployment rate has now reached double digits. And the Ministry of Finance is reporting a 16% in personal income tax collected year over year. China's boom days may be over realistically, because capital and people are heading for the exits. $500 billion may have fled the country in 23 alone, and the hemorrhaging is continuing. And of course, they're saying may have fled because nobody can keep track of the real amount of money, because people are sneaking it out. But there's a lot of money. And I always knew that was going to be one issue with China, because when people get rich, some people want to leave. So the bottom line is, maybe too much government control isn't always such a good idea, or actually it's never a good idea. You can please take notes, socialists and communists, when you look at the history for thousands of years in hundreds of countries, it tends to not work. It tends to lead to dictatorship. It tends to lead to economic collapse. And I could argue about the one example that they can give in Scandinavia, because they're oil rich and agricultural rich. And right now it's working, although US tax rates are already higher than in Scandinavia today. And if some proposals go through, they'll be some of the highest in the world. Interesting story number 3 is part of 2 futuristic stories. New York will soon see self-driving cars snaking their way through city's traffic choked streets. but the vehicles won't be driverless. Mayor Adams has now signed off allowing several companies to deploy the autonomous vehicles. He said, quote, "This technology is coming whether we like it or not." That is probably true. And driverless vehicles are going to be interesting because it's part of the AI revolution. But what may affect the economy a lot is 9% of U.S. jobs right now are driving, and that excludes 2% in trucks. Those truck drivers probably won't be replaced, but you're talking about 9% who are livery cab drivers, Uber drivers. Those jobs, what happens if those go away? That could be a shock. The second futuristic story, and that's even more today. So there's no business like show business, and now robots are getting their big break thanks to Alba Renai. Alba Renai is a successful influencer, and she's also an AI robot. She doesn't exist. And she will be the first non-human host on a weekly special segment of Survivor in Spain. The robot will not require any salary, and as a matter of fact, they don't even have to give her benefits. So if the future isn't here, it's sure coming fast. Finally, interesting story number 5. Headline: Pluto is still a planet in Arizona. So Arizona declared Pluto its official state planet, despite it being relegated to dwarf planet status nearly 2 decades ago, when the International Astronomical Union in 2006 said Pluto was not a planet, and it was reclassified as a dwarf planet because it hasn't cleared enough of its neighboring region of other objects due to its low gravitational pull. So at least in Arizona, Pluto is now a planet. Strange world in many ways. Anyway, we'll take a quick break, and then we'll talk about the dividend pick of the week and the panel discussion. See you in a moment.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Couliet. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
So, dividend pick of the week, but first, some disclaimers. This show is for entertainment only. There are no guarantees. Of course, nobody can guarantee any investments. Only our opinions, and consult your financial advisor. A quick note on last week's show. I'm making an adjustment. I had said I was going with DIVB in our model portfolio for 3%, and I've just cut it back to 0.5%. I'm a little nervous about what might happen in the market this summer with oil and then if there'd be a pullback. That said, a lot of times I should have just stayed with it. Just as example, I said short Tesla a few weeks ago, and I pulled out and did well with it. But yesterday it this week it plunged like 5% in a day, and I wouldn't be surprised if it goes to zero, although there's no guarantee on that either, and I don't recommend that as a trade anymore. It's up to you, but it's got issues, and it's a risky investment. Anyway, so DIVB, I'm down to 0.5%, but I'm watching the market. I may jump in back to 3 anytime. The other thing is, a while ago, I recommended a very small, under 0.25% allocation to JEPI, JP Morgan fund that it hedges a lot, does options to try to generate extra money. And I read an article, and it pointed out that it really has underperformed the market substantially in the last few years. I liked its makeup and the idea of selling options, but it also has what are called ETNs, which are notes, which are derivative notes, and they have issues. And that was the article said it was 20%. So dropping less than 0.25% was no big deal. I broke even on it anyway. So this week's pick is an interesting one. It's AMLP, the Alerian MLP ETF. And this, in our model portfolio, we're going with about a 1% allocation, just under 1%. What do I like about it? Well, it has a 7.2% yield. You know, we love yield. And the yield might be either receiving dividend treatment or return of capital, depending on the year. It holds MLPs, which you know is my favorite sector, pipeline MLPs. And why do I love them? I've said it so many times. I think it's the only place to get a high yield dividends and growth, and still very defensive, very likely. So the portfolio holds two of our favorites, our largest allocation. And you look at MPLX, that's the one we've been recommending as our number one allocation for years. It was somewhere around 42.60, I think it was today. We liked it at 11. Just about 2.5 years ago, maybe 2 years ago. And then we liked it at 23. I liked it at 30. And I still like it at 42. But that's another story. And also EPD, which is now, we recommended it again a few weeks ago and went with a bigger allocation. And it's been doing pretty well since then. So they hold those two. But what it also holds is quite a number of other MLPs, which I keep looking at and saying, I don't like them as much as MPLX or EPD, but they look good, and maybe I should be in these. So you get an instant diversification. They hold Western Midstream, Plains All American, and Energy Transfer. I'm not sure of any of these in particular because I think each one has its own issues, maybe. But that said, it's a great sector. So this way you're getting a diverse cash flow. But I would point out that tax-wise, especially an American investor, you're better off just holding it outside an IRA, especially because in an IRA you have UBTI. But basically, it's a nice way to diversify in the pipeline sector, and I think a nice way for worth 1%. So, panel discussion of the week. Question is, where is energy policy heading in the U.S.? And first, background, and Nick will be coming on. So we have 4 concerns, and I think each one is pretty significant. I'll go through those concerns and then we'll discuss it. So each one's independently of maybe huge concerns. Number one, U.S. energy producers have been putting in less than half the capital that they had been before 2018. So for the last 8 years, they've been underinvesting substantially. Why? Because of low prices from 2015 to 2020, they underinvested. But now for the last few years, because the Biden administration has taken over 100 different actions, many substantial, in order to slow U.S. energy production. Examples are severely cutting back on federal leases, on federal land, shutting and slowing pipeline development, and very substantial increases in energy regulations. Also, oil and gas companies are putting in 10% of their budgets into environmental projects like carbon sequestration. So that's also not going into production. These projects take 5 to 7 years to come to full fruition. So you don't always notice it right away. There's a lagging effect. But now it's been about 8 years of underinvestment, so that could be a major concern. Number 2 major concern, the U.S. and the world are fairly heavily, to say the least, pushing EVs. Now, it may be very unaffordable, as we said, to buy a gas-powered truck or car very soon, but there's a lot of issues here. Number one, this is going to help the Chinese auto industry phenomenally. It's going to hurt dramatically the U.S. auto industry, maybe crush it, probably. And also it's going to drive inflation because these cars are expensive, and there's all kind of issues with battery replacement and their cost and everything like that. Third concern, and this is surprising, but on carbon and pollution. So carbon output, both in the U.S. and the world, I'll repeat it, in the U.S. and the world, was higher in 23 than in 22 and higher in 22 than 21. Carbon pollution is increasing. And why is that? Well, first of all, the war on fossil fuels is not being done strategically. So they attack natural gas as if it's just as bad as oil and coal. They attack oil as much as if it's as bad as coal. So what happens? There's not enough natural gas, so people have to use oil and coal. There's not enough oil, so people have to use coal. And this has been documented. So there's a lot of issues there. And also the third thing is there's a lot of hostility between the current governments and oil and gas companies in the United States and probably other countries. And they should be working with them because they have to be part of the solution. Carbon sequestration and technology has to be the answer. So also quickly, the single EV battery requires 500,000 pounds of mining, and a recent study shows that these tires on these cars, because they weigh 1,000 pounds more, are spreading particles at 1,800 times the rate. Nobody's even know if this is going to help. And finally, I better go quickly. We'll run out of times. EVs. Elon Musk said that EVs alone could double the required energy in the United States, and also data centers are going to require a huge amount of extra energy. So this is on one side why it's good to look at energy investments in utilities, but on the other side, there could be a substantial stress on the grid, maybe power shortages. Nick, we only have about 3 minutes, but I tried to rush there. What do you think? What is the U.S. energy policy heading?
Well, the thing is, if you want to know what the U.S. policy is, you want to look at the budget of the United States government, because this is where you can find the energy policy, and this should be required reading of everybody in the United States. And so we do try to reproduce that for people to look at. The budget's 188 pages, and here's what you're going to see when you start reading it. Trillions of dollars are being spent on climate change. All they're doing is just throwing money, saying, hey, you've got a climate change, here, we'll give you some money. You got a climate change idea, here's some more money. And so there is no real policy. The policy is spend, spend. And that's it. Okay, now what happens when they spend? Two things. Number one, inflation, which everybody's going to pay for. Higher taxes for inflation. Number two, there's no maneuverability. When Medicare goes out broke this decade, what will happen is they're going to look to the U.S. government to pay Medicare, and they're going to find there's no money. Then when Social Security goes broke the next decade, they're going to look to the U.S. budget with no money.
Perfect.
So what you have is a train wreck waiting to happen. And so what I encourage people to do, Peter, is to go read the budget of the United States government. It's on the internet. It's not required reading in law school. It's not required in undergraduate, not required in MBA, not required in high school. Not
Nick,
required at all.
I have to cut you off because we have a minute left and we're always tight. But you know what? Everything you said was perfectly said. That's the point. There is no planning. The United States is intelligent, strategic, long-term planning on some of these issues. Companies at least do 5-year plans.
Companies
you can't even get a budget out for this month. It's always a daily battle, and because of the division in Washington. But the two sides have to realize there's bigger issues than the short-term issues they're fighting about. And so, in terms of if you're an individual investor, this can lead to opportunities, as in energy pipelines and inflation being something you want to take advantage of to a point, or at least guard against. But in terms of policy, the world and the United States has to think more deeply. Let's put it that way. So we're out of time, as Kim says. Get healthy, get wealthy. And thanks for watching Wall Street Hackers. We'll see you next week.
See you next week. Bye-bye.